Welcome to the first section of the ASC 480 training series from PNJ Group. Today, we are starting with the question that makes this entire topic matter. What is actually at stake when a financial instrument is classified incorrectly? By the end of this section, you will understand what the standard covers, why the consequences are serious, and the key terms you need to navigate the rules confidently. Here is what you will be able to do after this section. You will be able to explain exactly why getting the classification wrong creates serious consequences across the financial statements. You will identify which instruments a SC 480 covers and which ones are handled by other standards. You will define the key terms that appear throughout this standard, and you will apply the central principle, substance over form, to real classification questions. These are the foundations everything else builds on. Here is the thing about a SC 480 that surprises people. This is not a technical nuance that only affects a footnote. A single classification decision, liability or equity, changes what appears on the balance sheet, how earnings are reported, what happens to EPS, and whether a company is in breach of its debt covenants. And when it goes wrong, the consequences are not just internal. Misclassifications in this area regularly result in financial statement restatements. That is why auditors treat every instrument touching a company's own equity as a high-attention area. Start with the balance sheet. If an instrument is classified as a liability, it sits in the liabilities section. Total debt goes up. Shareholders' equity goes down. The company looks more leveraged. If the same instrument is classified as equity, none of that happens. It sits in stockholders' equity. Leverage ratios are unchanged. Now think about what this means for a lender reading that balance sheet or an investor comparing two companies side by side. The same economic instrument produces a completely different picture depending on which box it lands in. The income statement consequences are just as significant. When an instrument is classified as a liability, fair value changes flow through the P&L every single reporting period. That creates earnings volatility that has nothing to do with the company's underlying operations. And here is the part that trips up a lot of teams. Dividends on liability-classified preferred stock are not equity distributions. They are interest expense. They reduce reported net income, which in turn affects EPS under equity classification. None of this happens. No P&L impact. No earnings volatility from the instrument itself. The ripple effects go further. Because liability classification reduces net income through interest expense and fair value charges, it directly reduces income available to common shareholders, which flows into both basic and diluted EPS. Analysts and investors track EPS closely. A misclassification here distorts the numbers they rely on. There is also the debt covenant angle. Many loan agreements specify minimum equity ratios or maximum leverage ratios. A reclassification from equity to liability can push a company into technical default on its debt without a single dollar of actual cash ever moving. That is the kind of consequence that gets everyone's attention fast. So what exactly does a SC 480 govern? The standard applies to financial instruments that are indexed to or potentially settled in the entity's own equity, specifically where the instrument has characteristics of both liabilities and equity at the same time. This standard applies to all entities, not just public companies. In practice, a SC 480 is most commonly triggered in three situations: preferred stock with redemption features, arrangements where shares are used as consideration in service agreements, and share repurchase contracts. If your entity is involved in any of these, a SC 480 analysis is not optional. Here are the instruments that bring a SC 480 into play. Mandatorily redeemable preferred stock, where the entity must redeem the instrument for cash at a fixed date or upon a certain event. Written put options on own shares, where a counterparty can force the entity to buy back its own shares. Forward contracts to repurchase shares, where the entity is contractually obligated to buy back shares at a future date, and obligations to issue shares for a fixed dollar value, where the number of shares varies based on price. Each of these has an element of obligation that distinguishes it from plain equity. We will go deep on each category in the next section. Equally important is knowing what a SC 480 does not cover. Derivatives on own equity are analyzed under a SC 815. Employee stock options and awards go to a SC 718. Regular convertible debt, where the conversion option alone does not create a liability, falls under a SC 47020. And ordinary common stock, which represents a pure residual interest with no redemption obligation, is governed by a SC 505. Knowing the scope boundaries prevents the common mistake of overapplying a SC 480 to instruments that belong under a different standard. Before you can apply a SC 480 confidently, you need to be precise about what these terms actually mean. Mandatorily redeemable means the instrument must be redeemed, not might be, not could be. A fixed date or a certain event. Unconditional obligation means the entity cannot avoid the transfer of assets. Variable share obligation means the entity owes a fixed dollar amount but delivers shares to settle it. The number of shares fluctuates with the price. Mezzanine equity is a SEC-specific concept for instruments sitting between liabilities and permanent equity. And permanent equity means no redemption and no features that could force the entity's hand outside its own control. These terms are used precisely throughout the standard Precision Matters. The entire standard is built on one principle: substance over form. An instrument may be legally called preferred stock. It may sit in the equity section of an old balance sheet. It may have been described as equity in every board resolution. None of that matters. If the instrument requires the entity to transfer assets to the holder at a fixed date, upon a certain event, or to settle a fixed dollar obligation, it is economically a liability and must be presented as one. The question you need to train yourself to ask is not what is this called. The question is, does the entity have an unavoidable obligation to deliver cash or other assets? If the answer is yes, the classification answer is liability. Let us lock in the key ideas from this section. Misclassification under a SC 480 is not a minor issue. It touches the balance sheet, the income statement, EPS, and potentially debt covenant compliance at the same time. The standard applies to all entities, and 4 categories of instruments bring it into scope. When you encounter any of these instruments, substance over form is your guiding principle, not the legal name, not the historical treatment, not what the client calls it. And precise command of the terminology is what makes the analysis rigorous rather than guesswork. In the next section, we go through each of the 3 liability categories in detail. Thank you for completing this section on the stakes and scope of a SC 480. Thank you for watching. Subscribe for more training from PNJ Group.